Practical accounting, the better way to learn.
Okay, making sense of the accounting equation. Let's demystify it. The accounting equation is assets equals liabilities plus owner's equity. Okay, this was developed by a monk in the Middle Ages. We're going to demystify it for you. Owner's equity, as we just saw with Hot Dogs Are Us, is made up of two major pieces: contributed capital, which is invested into the business, and retained earnings, which are profits, which are kept in the business. Now, retained earnings are revenues or sales minus expenses, which are consumed, minus dividends, which is money given back to the owners for contributing their capital. You probably will see this form in your textbook and maybe your homework early on, and then they'll stop using it. This is really confusing to students because we have double negatives happening here with our expenses and dividends. In other words, if an expense that goes up, does it go up or down? But be careful about this format here and be really careful in your homework software. But we're going to do something we call the practical T, and we're going to consistently do this for the whole course. We're going to add expenses and dividends to both sides of the equation. And we're going to end up with this line. And this is the way we're going to do it. We call it the practical T. Assets plus dividends plus expenses equals revenues plus contributed capital plus liability. Now, when you think about this, on this side, or on the right side here, you can get money into your business three ways. Revenues are things you sell, or by the owners investing in the business, or you can borrow money from creditors. You use that money for three different things. You use it to buy things that the business owns, to reward the owners of the business, or to pay for expenses to operate the business. If you do it this way, when you add to this left side, it's a debit, and you subtract, it's a credit. Okay, but it's important to understand the ups and downs first and have them make logical sense. If you add to the right side, it's the opposite. Okay, it's a credit, and subtract is a debit. Again, John and I have been using the practical T for a long time, and both in class and in his lab, and it really sets you up for success. Instead of memorizing it, you learn it this way. I suggest you really print out this one, or you'll get used to it really quickly. Now, how does this relate to you as a student? Well, assets are things you own, like your books, etc., your clothes, etc., maybe a car. We're going to skip dividends right now. Expenses are things like college tuition, anything that you're buying that is a service then you can't store, or things that are consumed. Your laptop's over here as an asset. Your revenue is your summer job. Your liabilities are your student loan and your credit card. Hopefully not too big a balance on that. Now, you also might have contributed capital. Contributed capital doesn't, unlike liabilities, contributed capital is not paid back. So suppose you have rich Aunt Betty. Rich Aunt Betty is going to give you a nice check every semester to help out on your tuition. So again, this would be a grant. So what is a dividend going back here? One of our uses of fundings? Well, this dividend is like Rich Aunt Betty has a birthday birthday coming up. You're gonna buy her a card, maybe even some flowers, okay? And say thank you, Aunt Betty, for contributing capital because she doesn't want to be paid back, but you're going to return some of your good fortune to her and thank her that way.
Oh, cool. But she's kind of invested in.
She's invested in you. Yeah. We all good?
We're good.
Okay, we're going to use the practical T for the rest of this course. You can get this Excel workbook and a whole lot more
Stuff for free at practicalaccounting.com.
See you there.